Yeah, the latest print of US core CPI earlier this week were better than expected, modestly, and it confirms that core CPI is now converging toward the central bank targets a bit more visibly, and we expect that to continue into 2024, which bodes well for central bank easing, and we expect the Federal Reserve to cut rates in the second half of next year, possibly more visibly or more substantially than the markets expect, although it will be dependent on further slowdown of the US economy. In Europe, which is more visibly confronted to a sharper economic slowdown, the central bank may take actions faster and for the first time maybe in history cut rates before the Fed does, which is justified also by some deceleration in the CPI on the goods side, like in the US, but also on the services side, as we've now been seeing in the US. Yeah, with the Fed policy plateauing and rates having reached a new range, we definitely think investors should allocate more to bonds, and then bonds are back this time. We like particularly investment grade in a context where companies could continue to suffer with slightly tighter monetary conditions. So investment grade, quality high yield in the US. Turning to emerging markets, we see some opportunities in the corporate space, EMD corporate, that we think will take advantage of some easing of the dollar liquidity in particular. And looking at local debt, this easing dollar liquidity will be favorable for local markets, so more particularly we like Indian bonds, we like Mexican bonds, notably. I think investors have showed a lot of pessimism on the Chinese economy, and admittedly the stock markets has reflected that in the course of this year. Now, over the recent weeks, we've started to see two things. Firstly, a ramp up of the policy action. It remains piecemeal, but it clearly shows evidence that the Chinese authorities will continue to support credit, maintain the economic and monetary cohesion, and bring confidence back for households in particular. We've seen some uptick in both business and household surveys. Secondly, inflation is well tamed in China, and as a result, it gives a relatively favorable perspective for CGBs. And finally, given the discounts on the Chinese stocks, if I may digress on that, the level of undervaluation shows that risk is very asymmetric, not a lot of downside necessarily, and some upside given the level of pessimism at the moment.